What's going on, everybody, and welcome on into the TC Trading channel. So today we are talking about delta in options. So we're diving into three of the top, used Greeks across options trading in the next couple of videos. So this video is going to be essentially all about delta. The next videos will be about gamma and theta. So if you guys are watching, definitely check out some of our playlists down below so you can see those videos if you're watching after the fact. If you're watching in real time, right when it gets posted, stay tuned and make sure you're subscribed. Hit that thumbs up button so you don't miss when we post those videos. This channel primarily is more so about educational content and tutorial content. So we dive into stuff that ideally is going to help you. We're not talking top stocks. We're not talking any of that stuff. We are talking about the backbones to trading, building trading plans, how to use different platforms, all things like that. So we're going to be talking about delta. If we dive into Webull, which will be the platform that we recommend, and we'll zoom in really quick. It's tough to see, but it's up here in the top left. We have delta next to gamma on the option chain, and over on the right, on the put side, we have delta second to last before gamma on the put side of the option chains, all at the top right there, okay? If you look on the call side, you can kind of see these numbers are in the positive, and we can range from close to 1 all the way to pretty much 0. And if you then look over into the other side, the put side, we see these numbers are negative, and they range from pretty low, just looks like 0.045 on the low end, to on the high end, at least based on the contracts we're looking at, and we're only looking at 20 strikes, so 10 strikes north above the current price and 10 strikes below the current price. These range from just, almost 0 to pretty much almost 1 on the negative side. Now, that's a key number. 1's a key number. We'll talk about that and what that means and how you can utilize that so you know what you're buying right before you buy a contract. And I think if you're trading options, you need to know this stuff. So we're not going to read this Investopedia article because we're going to explain it a little bit better, but we are going to take away some key points. So the delta is essentially a ratio that is referred to as the hedge ratio. What you need to understand is that it compares the change in price of the underlying asset, which is the stock, with the change in price of the option contract that you're looking at, okay? So you need to get that ratio, and depending upon that ratio, the option contract is going to move X number of cents based on a move in the current stock price, okay? So that's what we're looking at. So it's very helpful to look at delta when you're talking about in the money, out of the money options. It doesn't matter what you're trading, you need to understand what the delta is, or you should understand what the delta is to some degree before you buy that option. So when you can calculate price targets, many times you're calculating price targets based on the underlying stock. You will then be able to back your way into roughly how much that option contract is going to move up or down based on that move in the stock price, which is huge. And one more thing before we dive into examples, generally, an at-the-money option that is close to where the stock is trading, you're generally going to see a delta at 0.5 or negative 0.5 if you're looking put. So 0.5 for calls and negative 0.5 for puts. Okay, so let's dive into the option chain again, and I'll zoom on in so we can see this a lot better. Okay, we are currently looking at a specific contract. Let's actually move our way out and let's look at the leap contract. We have a video on the channel recently diving into leaps. So leaps, what they are when you're looking at contracts that are about over 1 year in the distance, right, in the future. These are leaps. So they're going to be a lot more expensive because you have so much time until they expire, but they could be seen as a great way to leverage your money, right? For example, on Apple right here, you can leverage, let's say, $2,800 to buy $145 call option leaps. They don't expire until September of 2023. When we're making this video, it's not even 2022 yet. We're getting closer and closer, but it's not even 2022. Okay, so these expire quite far out in the future, but rather than having to buy, a couple hundred shares to reap the same rewards in terms of profits, in terms of a dollar amount profit, you can go ahead and buy these contracts, and based on the delta, right, you can start to calculate, and that can help you calculate how much these could be worth in the future based on a move in the Apple stock price. So we take a look right here. The current price of Apple is 146, and the strike price we're looking at is 145. What's the delta at over on the left-hand side? It's actually just to the north of 0.5. So it's roughly around that 0.5 that we just talked about a few seconds ago. So what is delta going to tell us right now? We roughly know it's a correlation between the asset price and the option price, the stock price versus the option price, right? What does it mean? Okay, take a look at this. Let's look at these $100 call options for Apple. We have a delta of 0.81. What does that mean? This means roughly for every $1 move in Apple's price, Apple's stock price, this contract, these $100 call contracts that are currently, there's a decently large spread on them as of right now, but these call contracts, because they do expire so far out, but these call contracts will roughly move 81 cents. Okay, so let's say Apple's trading at 100, Apple goes to 101. These contracts should have 81 more cents behind them. Now, obviously, if you're looking at a contract with a smaller spread between the bid and the ask, it will make more sense in terms of how you can see that. So we can do that here really quick. Let's go back to like a more recent one right here. If you look at, let's say, the 140 contracts right here, there's this very tight spread. They're trading at $6.25. Okay, these contracts have a 0.8575 delta. So let's say Apple goes from where it's at right now, it goes to 147.14. These contracts will now be worth 85 cents more. So they'll now be worth just over $7, which would be almost a $100 gain, right? If you have one contract. And of course, more contracts, the more money you're going to gain on those contracts. Now it's the exact same thing on the put side, except the deltas are negative. Let's look at a put right here, a $160 put. We're looking at in the money puts. And we generally like to play in the money plays here because they're a little bit less risky, but if you're playing more lottery plays, out of the money could be a good idea. However, make sure you understand the risks. Those could expire worthless if you're looking at a very short-term option contract. But $160 puts on Apple, so Apple's nowhere near that. It's like, $15 or $14 off from that 160. These puts are going between $13.80 and $13.95. Okay, that's how much it's going to cost you per contract. Times that by 100, that's your actual dollar amount. So it's actually going to cost you just nearly $1,400 to buy one contract at this current price, this current strike point right here. This has a negative 0.9287. So let's say a negative 0.93 roughly. So what this means is that for every $1 move to the downside in Apple stock, so for example, Apple's at 146 right now, Apple drops to 145.14. Every dollar move to the downside on these contracts, you're going to see a $1 increase in the contract value because we're playing puts, and because puts, we make money when the stock goes down. Roughly speaking, guys, that's what delta means. Hopefully that makes some sense. Go back, and if you have to rewatch, hopefully that was clear, and hopefully you get a good understanding of what delta means, okay? Just make sure you look at that on the call side. You're looking at this number being positive. On the put side, that number is negative in terms of that correlation. Now also, same thing goes for if the stock goes down. Roughly speaking, the delta will change over time, slowly. But if this option, for example, this 160, the further it gets into the money, the closer this number gets to 1. And same with these 140s. The further Apple moves up, the further in the money these goes, the closer this delta will go to 1. As you start to see, if you start pushing up, we have, the 140s have a delta of 85.85, the 139s have a delta of 0.89, and you can kind of see how that plays out. Same exact thing on the downside though. So if Apple was to, let's say on the call side, let's say you had these 140 calls, and if Apple drops down to 139, or Apple drops to 145 at the current price point, right? Apple drops to 145, these are going to lose value roughly 85 cents per contract. And so that's how you want to look at that on the downside as well. And the exact same thing on the put side. Let's say Apple here, these $160 puts right here, 160, we can see a negative 0.93. If Apple was to go up, because puts make money on the way down, if Apple does go up, in this case $1, you're roughly going to lose about 93 cents of premium, which would put those contracts back down closer to about $13 per those contracts right there. So that is delta, guys. Let us know in the comment section down below your thoughts and how you'll be able to use this in your own trading. It's definitely, and one of the Greeks that you definitely should have a good grasp on. It's very helpful to see this. And by no means is this anything secretive that like no one knows, but if you're about to buy an option contract, just have a good sense of what the delta is. And if you're expecting a move of $5 in the price and the delta is 0.5, roughly speaking, that contract has range to go about $2.50 in whatever direction you're looking for that move. Roughly speaking, of course, that delta will change depending upon how far in the money it gets, but roughly that could be a good area of price target that you can set on your option contracts, because everyone likes setting price targets on the actual stock in terms of stock price, but now it helps you back your way into targeting certain price points for your option contracts. Thank you guys so much for tuning on in. I appreciate you guys so much. Hit that thumbs up button. Consider subscribing. We have plenty plenty more videos where that came from on options. Check out our options playlist down below. If you have questions about Webull, the platform that we use that gives you guys 2 free stocks, when you deposit $5 and sign up on the platform, the link will be down in the pinned comment and description box down below if you want to go ahead and do that. Tons of resources here on this channel. Thank you guys so much. Hope to see you in a future video. Peace.